Okay, welcome. Today we are diving straight into the high-stakes world of finance.
Mm,
Specifically, we're looking at the Morgan Stanley Shareholders Letter from April 2018.
right.
This is all guided by the vision of Chairman and CEO James P. Gorman. And, what makes this document so interesting, I think, is that it wasn't just another annual update. It really felt like a declaration.
That's precisely right.
Yeah.
For you, the listener, think of this letter as a pivotal roadmap.
Okay.
After more than a decade, really, of post-crisis repositioning, 2018 was the moment Morgan Stanley seemed confident enough to say, look, the transformation is complete.
Right.
Now we're setting these pretty aggressive, measurable targets for superior performance.
Yeah.
And we're telling the market exactly where we're putting our future investment money.
Yeah, and what stands out immediately, and it really anchors this whole document, is just how long that preparatory journey was. I mean, the firm spent, decades fundamentally transforming its business mix and, crucially, its risk profile.
Shedding risky assets, building up capital.
Yes, exactly.
Right.
Building up regulatory capital, and they specifically state they capped that whole process in 2017. They felt they were finally engineered, to perform consistently well, whatever the market cycle.
Yeah.
So the question then becomes, okay, you've built this stable fortress. How high did they actually aim for growth?
Well, they aimed high, but importantly, they had recent proof points to back it up.
Okay.
Those strong 2017 results were the validation they needed. Firm-wide net revenues jumped 10%.
It's just solid.
And crucially, pre-tax profit rose 18% over the previous year. Now, that gap between revenue and profit growth, that shows operating leverage.
Right. Meaning for every new dollar of revenue coming in, more than its proportionate share was dropping straight to the bottom line.
Exactly. Leverage working for them.
So this is where we move from sort of historical context to strict accountability.
Mm-hmm.
They immediately laid out these non-GAAP medium-term financial targets. And look, setting targets is easy, right? Justifying them and actually hitting them, that's where the real strategy comes in.
Let's maybe start with the cornerstone numbers, return on equity.
Okay, yeah. They set the goal for return on equity, or ROE, at 10 to 13%.
10 to 13.
But what's maybe even more telling is their focus on return on tangible common equity, ROTCE. They targeted that even higher at 11.5% to 14.5%.
Okay, I want to pause on ROTCE for just a second, because we hear acronyms all the time in finance. But why is ROTCE often seen as, well, the superior metric for a place like Morgan Stanley?
Well, it really signals management's intense focus on core performance. When banks make major acquisitions like Morgan Stanley did with the old Smith Barney,
Right.
they record significant goodwill or intangible assets on the balance sheet. ROTCE basically strips all of that out.
Oh, okay.
So it gives you a much clearer, cleaner view of the returns generated purely from the capital that shareholders can, physically see and touch.
So aiming for 14.5% ROTCE. Yeah, targeting 14.5% ROTCE signals they truly believe they could deliver returns way above the cost of capital. It's a really powerful commitment to shareholder value.
Got it. And efficiency was clearly another massive priority. I mean, they'd already achieved a very impressive expense efficiency ratio of 73% in 2017.
Right.
But the goal wasn't just hitting it, it was to maintain it at or below that 73% level. That shows a deep, sort of ingrained discipline.
It does, but here is maybe where we apply a bit of a critical lens.
Okay.
In an industry that's undergoing radical technological change, where competitors are aggressively cutting costs through automation, is maintaining 73% actually aggressive enough?
Good point.
The letter talks about massive future investment in technology, which usually increases costs in the short term.
Right.
So sticking to that 73% means they expected those initial investments to be immediately offset by operational gains somewhere else. I mean, that's a major logistical lift.
It really is. They also emphasize capital. Morgan Stanley stressed capital sufficiency, and their, pretty aggressive plan to keep returning capital to shareholders, obviously subject to regulatory approval.
And they had momentum there. They'd already increased their return of capital in 2017 by 12%, which totaled $5.4 billion.
$5.4 billion.
That combination, strong growth targets, relentless focus on efficiency, and a robust capital return profile, that's really the strategic trifecta of a mature post-crisis financial firm.
Right.
They're essentially saying, look, we are stable, we are efficient, and we're ready to reward you, the shareholder.
So, okay, how are they actually going to deliver on those high targets? The strategy seems to rely heavily on the stability from the three complementary franchises.
Wealth management, institutional securities, and investment management.
Right, which they claim provide structural earnings stability. Let's start with the big one, the money magnet. Wealth management.
Yeah, wealth management, or WM, is definitely the engine of stability for them. At the time of this letter, they were managing a colossal $2.4 trillion in client assets.
2.4 trillion.
Wow, just sheer scale. And this scale allows them to benefit from significant secular trends, specifically that long-term industry shift away from commission-based trading toward predictable fee-based assets under management.
And the financial expectations for this business were clearly rising. They were aiming for a pre-tax profit margin of 26% to 28% over the next 2 years.
Right, pushing up from 25.5% in 2017.
And that 0.5% jump, I mean, on trillions of dollars, that's substantial.
It absolutely is. Operationally, the focus was deepening the lending footprint.
Okay, explain that.
Well, this is a crucial high-margin activity. If they have your, say, $10 million in assets, they want to be the firm offering you the mortgage or the securities-based loan or the line of credit. It locks clients in deeper, generates interest income, and diversifies their revenue stream even within the WM unit itself.
Makes sense. Okay, moving to institutional securities. This is the traditional, maybe higher volatility investment banking arm.
Right.
The strategic focus here was pressing their advantage in traditional strengths: investment banking advisory and equity sales and trading.
And they proudly maintained a #1 global position in equity sales and trading revenue wallet share in 2017. That's a real testament to their platform.
Huge.
But contrast that success, however, with the fixed income sales and trading business, which, as you know, was undergoing massive compression across the entire industry.
Yeah, that's where I get a bit skeptical. They noted the necessity of maintaining a credible and critically sized fixed income sales and trading business. It generated $4.9 billion in revenues in 2017.
Right.
But back in 2018, wasn't critically sized, just kind of corporate speak for, look, we need to maintain a presence, but we're definitely not prioritizing this volatile, low-margin business.
You raise an essential point there. I mean, given the dramatic capital requirements regulators imposed on fixed income trading post-crisis, maintaining $4.9 billion in revenue with fewer resources probably suggested extremely efficient resource allocation. They weren't trying to win the FICC arms race anymore.
Okay.
They were just ensuring they were large enough to serve their major institutional clients across different market conditions, providing essential coverage without sinking disproportionate capital into it.
Yeah.
So yeah, maybe a strategic retreat disguised as critical sizing.
That makes sense. And that equity trading success wasn't accidental either, right? They explicitly mentioned combining the traditional high-touch human advisor model with their then evolving market-leading low-touch electronic model.
Yeah, and that combination is key. High touch means personalized advice and execution for the large, complex deals.
Right.
Low touch means those lightning-fast, highly automated electronic platforms from massive standard trading volumes. Having both allowed them to maximize wallet share across the entire client spectrum, very smart.
Okay, finally, let's briefly touch on investment management, IM. The strategy here seemed pretty straightforward. Growth, leveraging their attractive mix of investment strategies and their global client footprint.
Yeah, the key metric here was achieving 5% long-term organic growth in net flows in 2017. That means they were growing the capital they manage through performance and distribution, not just, buying other firms.
Right, organic growth.
And the strategic differentiator they highlighted was that long-standing partnership with Mitsubishi UFJ Financial Group, or MUFG.
Yes, the MUFG partnership. That's always been fascinating. It combines Morgan Stanley's global asset expertise and reach with MUFG's massive lending capabilities and deep client footprint, specifically in Japan.
Exactly. That gives them a distinct advantage in accessing one of the world's largest pools of capital.
It's like a localized hedge, isn't it?
Kind of. It provides immediate leverage in a very mature and, frankly, loyal client market, reinforcing their commitment to international growth outside their core U.S. business.
Okay, so this brings us neatly to the segment where the firm seems to be making its biggest future bet: technology. Gorman clearly stated that technology is both a massive challenge and an unprecedented source of opportunity. He said it will fundamentally alter the cost structure of the industry over the coming decade.
And it's not their first rodeo with disruption, as the letter acknowledges.
Yeah.
The 1990s brought the birth of the online brokerage.
Right, democratizing access.
Then the early 2000s saw the proliferation of electronic trading systems using complex algorithms. But today's challenge feels more comprehensive. It touches the front office, middle office, back office, all at the same time.
And cybersecurity is listed right at the top, the foremost challenge above all others.
Yeah.
They noted investments in cyber tech had grown multifold, not just double, but multiple factors, and they're actively collaborating with industry peers and government bodies to tackle these persistent, often state-level threats. This isn't just IT, it's like existential risk management.
Which, going back to our earlier point, eats into that efficiency ratio.
Yeah.
The sheer expense of maintaining adequate cyber defense means the firm needs revolutionary gains elsewhere to even hope to maintain that 73% target.
And those gains are presumably coming from the massive digitization effort, particularly in wealth management.
That seems to be the plan. Let's talk about that implementation.
Yeah. The goal is to digitize the traditional branch system using mobile and digital tools. And this sounds like more than just an app. It's an internal transformation.
Definitely. It's aimed squarely at freeing up financial advisors, FAs, to spend less time processing paperwork and more time actually advising clients.
Right.
And this operational shift is where the potential cost savings really lie. I mean, imagine an FA spending, say, 30% of their day on admin tasks.
Easily. Compliance checks, onboarding forms, routine stuff.
Right. If digital tools and maybe virtual assistants can automate, let's say, 80% of that 30%,
Wow.
then the FA's productivity and capacity instantly jump. That's a direct lever on profitability right there.
And looking further out, they also spoke about artificial intelligence and machine learning, AI and ML. They said it had the potential to touch every part of the business in the medium term.
Yeah, and they weren't just talking theoretical science. They detailed applications already in use back then.
Like what?
Well, the breadth is what's fascinating. AI being incorporated into investment algorithms to optimize portfolio creation and execution.
Okay.
Virtual assistants being deployed to handle routine client queries. But maybe the real game changer is in the analytical space.
How so?
AI and ML are organizing and analyzing these massive amounts of big data to deliver personalized insights and also detect fraud or compliance irregularities in real time.
Okay, so when they talk about personalized insights, are we talking about algorithms that might notice, say, a client's spending habits indicate a life change, like they just had a child or bought a second home?
Exactly.
And flagging that to the human FA so they can proactively offer specialized planning advice?
Precisely. The AI surfaces the opportunity, the human builds the relationship and closes the deal.
Got it. It converts data from just a swamp into actionable intelligence.
Right. And that drives the strategic goal we talked about earlier, deepening the lending footprint, all while controlling risk through smarter predictive compliance monitoring.
Okay, now let's shift focus for just a moment. We've talked metrics, we've talked tech stack. What about the intangible drivers?
Yeah.
People and culture.
Yeah, culture is absolutely foundational, especially in a business built entirely on trust. Since the firm's founding, way back in 1935, they've operated under 4 core sort of non-negotiable values.
Which are?
Putting clients first, leading with exceptional ideas, doing the right thing, and giving back to the community. Living those values, really, is what enables them to manage that $2.4 trillion in client assets in the first place. You can't do it without trust.
Absolutely. And finally, let's just quickly touch on the external backdrop. What was the environment like in 2018 that was maybe providing a tailwind?
Well, they observed a period of broad, synchronized global growth. So, the economic tides were lifting all boats, more or less. Domestically, in the U.S., they noted the enactment of significant corporate tax reform.
Right, the Trump tax cuts.
Which was expected to boost economic activity and, crucially for their institutional securities unit, stimulate corporate transactions and capital market activity.
And interest rates.
Rising interest rates were also viewed positively, but with a caveat, provided they were driven by a strong, expanding economy.
Yeah.
That supports the interest income component of the bank.
Okay. And they also added a kind of hopeful note regarding regulation, didn't they? Expecting common sense recalibrations in the financial services regulatory framework over the coming years.
They did. So while they acknowledged geopolitical risks, the overall message was that the environment seemed pretty conducive to hitting those ambitious medium-term targets they set out.
Okay.
So if we synthesize all this, the 2018 letter was really a firm declaration. Morgan Stanley saying, we're done transforming, now we're ready to execute.
Yeah.
Their confidence in delivering sustained shareholder returns was built on, well, the stability of their 3 core franchises.
Underpinned by
Disciplined execution, aggressive capital return, and, maybe most importantly, that massive strategic investment in transformative technology that promised to reshape their entire profitability profile.
So this deep dive really showed you, the listener, a major financial firm that successfully pivoted from, let's say, survival to stability, and then placed its biggest bet on digitization to drive future growth. They locked in clear, measurable targets for pretty much every single unit.
Which raises, I think, an important question for you to maybe mull over after this.
Okay.
The whole plan really hinges on technology, digitizing the traditional branch system, automating admin tasks using AI and mobile tools.
Right.
So if the human financial advisor is freed from all that processing and compliance work, what unique, non-automatable soft skills then become the most critical asset for that advisor's success?
Good question. Like empathy, complex negotiation, behavioral coaching.
Exactly. What are those skills? Because that's what the firm must find, develop, and ultimately reward if this whole strategy is truly going to succeed in the long term, in the digital age.